Hey everyone, Jim here with a new episode for the Grant Investments YouTube channel. In our previous episode, we talked about Bitcoin and how it was born out of the credit crisis when many people had lost faith in financial institutions and government. The idea of a peer-to-peer payment system without intermediaries sounded appealing, and Bitcoin was able to create something along those lines. But for a number of reasons, it has yet to become a mainstream payment system and has not replaced fiat currencies. The biggest problem, as we discussed last week, is its carbon footprint. It consumes a massive amount of energy. And in a world where more and more people are expressing concern over the environment, it's hard to imagine the hype around Bitcoin lasting once people fully appreciate that impact. Yet, despite all of this, Bitcoin is still with us and continues to rise in value. Why? Proponents point to its scarcity. It was created with a hard cap. There will never be more than 21 million Bitcoin in existence. And as long as people want it, with supply being limited, the theory goes, the price should keep climbing. It's often compared to gold, digital gold, a store of value as the new narrative goes. But to be honest, that argument doesn't work for me. A true store of value has intrinsic worth and a degree of stability. Gold and real estate are good examples. They both have real-world uses and their value is relatively anchored. Bitcoin, not so much so. I think it's more accurate to call it what it is, a speculative investment. So how is Bitcoin as a speculative investment? Well, it certainly has done well, but here's the thing about any asset that is lacking in true value. Its price is driven almost entirely by belief. And if that belief ever fades, things can unravel quickly. Next, let's compare Bitcoin to other investments that also exhibit scarcity, but in a different way. Take Apple shares, for example. Over the past decade, Apple has bought back more than $700 billion worth of its own stock. In 2024 alone, they repurchased over $70 billion. What that means is there are fewer shares outstanding, and that's scarcity, but unlike Bitcoin, it is scarcity backed by one of the most profitable companies in the world with massive cash flow, innovative products, and strong long-term prospects. And Apple isn't alone. There are many other companies actively buying back their shares, and it's a trend that has been accelerating. In the first quarter of 2025, S&P 500 companies executed about $283 billion worth of buybacks, nearly 24% more than the previous quarter and almost 40% more than the same period 2 years earlier. Large, profitable firms like Meta, Alphabet, and NVIDIA are leading this charge, joining Apple in returning capital to shareholders through repurchases. So when we talk about scarcity, this is a real-world example of how companies can create it in a way that's backed by profits, products, and long-term growth, not just belief alone. And that's why I don't invest in Bitcoin. There are too many other opportunities that make more sense. Again, that doesn't mean it won't keep going up in value. It might. It's just not for me. Next episode, we'll talk about Ethereum, so stay tuned, and as always, feel free to reach out with questions or comments.